Hello everyone, and welcome to Crossover Mind. Today, we're diving into a topic that's on every investor's and technologist's mind, the AI bubble. Are we heading for a crash reminiscent of the dot-com bust in 2000? I'm your host, Steve, and I'll be looking at this from a macroeconomic and financial analyst's perspective.
And I'm Lisa. I'll be bringing the technology and infrastructure strategist viewpoint to our conversation. It's great to be here, Steve. This is a comparison I hear all the time, and I think it's a crucial one to unpack.
It really is. The parallels seem so obvious on the surface. Manic investor enthusiasm, sky-high valuations for companies with unproven business models. It's easy to get a sense of déjà vu. But the big question is this comparison truly accurate, or is it fundamentally misleading?
I'd argue it's fundamentally misleading. It's a tempting narrative, but the underlying conditions are worlds apart. Comparing the AI boom to the dot-com era is like comparing a modern electric vehicle to a Model T. Both are cars, but the infrastructure, the technology, and the user base they operate in are completely different.
I like that analogy. Let's break it down. From your perspective, what's the single biggest difference between now and the year 2000?
It's the foundation. The dot-com boom was built on a promise. The internet was new, and the infrastructure was nascent. Most people accessed it through slow dial-up connections on clunky desktop PCs. There were no smartphones, no robust cloud computing, no mature software-as-a-service ecosystem. Companies were building products for a future that hadn't arrived yet. The demand was largely speculative.
So you're saying the "if you build it, they will come" philosophy was just a gamble back then?
Exactly. Today, AI isn't a gamble on a future platform. It's a powerful new layer being built on top of a mature, globally scaled tech stack. AI plugs directly into the 2 billion smartphones in people's pockets, into the massive cloud infrastructure run by Amazon, Google, and Microsoft, and into the SaaS tools that companies already use, from accounting to customer relations. The demand isn't speculative. It can be immediate because AI can integrate into existing workflows and start adding value from day one.
That's a critical distinction from a financial standpoint. In 2000, we saw investors pouring money into companies with no revenue, let alone profits. Today, while there are certainly speculative startups, the charge is being led by profitable tech giants who are integrating AI to enhance existing revenue-generating products. But that brings up the key investor question. Is the return on investment, the ROI, justifying the colossal spending? We see widespread enterprise adoption for pilot projects, but is it translating into the kind of productivity gains that warrant a full-scale long-term commitment?
That's the multi-trillion-dollar question, and it leads to another key difference: supply-side constraints. The main bottleneck of the dot-com era was bandwidth. The solution, while expensive, was straightforward: lay more fiber optic cable. Today's constraints for AI are far more physical and complex. We're talking about a finite supply of advanced GPUs from a handful of manufacturers, the staggering amount of electricity needed to power data centers, and even the physical land and water rights to build them.
And that sounds far less like the dot-com bust and much more like a classic CAPEX or CAPEX boom and bust cycle. We've seen this pattern in industries from railroads to fiber optics. A transformative technology appears, triggering a massive wave of investment in the underlying infrastructure. A period of overbuilding occurs, which is then followed by a painful period of digestion as supply outstrips immediate demand.
I think that's a much more accurate model. So if a pop does happen, it won't be a catastrophic collapse of demand. It will be more of a value shift within the technology stack. The value will migrate. For instance, as the foundational AI models themselves become commoditized, with open-source alternatives getting better and cheaper, the business of simply selling a generic model through an API will become less profitable.
So where does the value move to?
It moves to the layers that are harder to replicate. It moves to companies that own unique, proprietary datasets. It moves to applications that are deeply and seamlessly integrated into a specific industry's workflow. And of course, it remains with the providers of the core infrastructure, the semiconductor companies, the cloud providers, and even the utility companies. We'll see a flight to real-world utility, not a wholesale abandonment of the technology.
From a market perspective, this realistic pop would mean the pure-play AI companies with the highest valuations and the heaviest fixed costs are the most vulnerable. We would expect to see their stock multiples compress, venture capital funding would tighten, and we'd likely see a wave of acquisitions where the big established platforms scoop up struggling startups. It's a consolidation phase, not an extinction event.
Absolutely. This also means that even after a market correction, the change is irreversible. AI-powered features are already becoming a permanent part of our operating systems, our office software, and our development tools. That's not going away. The infrastructure that companies are building now to manage their data will just make it easier to adopt the next generation of models.
So for our listeners, whether they're investors, business leaders, or just curious observers, what are the key signals they should be watching to gauge the health of this boom?
I'd keep an eye on the unit economics. Watch the price per token for AI models. A rapid decline signals intense competition. More importantly, look for hard data on ROI from businesses. Are they expanding their use of AI tools after the pilot phase? Are they reporting measurable gains? That's the ground truth. Also, watch the progress of open source models. The faster they catch up to the frontier models, the more pressure there will be on prices.
And from a financial market side, I would say watch the CAPEX guidance from the hyperscalers, Amazon, Microsoft, and Google. When they start talking more about improving utilization and digesting our investments, it's a clear signal that the infrastructure build-out is slowing down. And don't forget the boring stuff. Check the secondary market prices for GPUs and the lead times for power transformers. Those are the canaries in the coal mine for this entire cycle.
To sum up then, while the hype feels familiar, the foundation is completely different. A potential downturn won't be a replay of 2000. It will be less about a collapse and more about a reallocation of value. The fundamental question isn't if AI is valuable, but where that value will ultimately be captured and sustained.
A perfect summary. The dot-com wipeout makes for a dramatic headline, but a CAPEX cycle adjustment is likely the more realistic, albeit less exciting, future. The challenge for everyone is to figure out where the sustainable value lies in this new landscape. Thank you for joining us again on Crossover Mind. At Crossover Mind, we provide the latest information on technology, business, and society, and delve into important themes beyond them. Don't forget to subscribe to our channel. Until next time, look forward to it. Goodbye.